Let's get you the latest from Pimco. Here's a quote from them. The US economy, like others, appears poised to achieve a rare soft landing, moderating growth and inflation without recession. But there are risks, such as the upcoming US election, one, and its implications for tariffs, trade, fiscal policy, inflation and economic growth. Joining us now on their outlook is Tiffany Wilding of Pimco. Tiffany, welcome to the programme. Lots to work through with you. The economic data so far in the last week, payrolls on Friday, CPI tomorrow morning. How old are those numbers going to look by the time we've worked through the election and have a better picture of what 2025 looks like?
Yeah, so I think that's a really great point. We have an incredibly big election on the horizon here with policies with either candidate that could look very different. You know, of course, the deficit we think is really the real loser here, with neither candidate likely to do anything about that or the longer term trajectory of government debt. But I do think that there are bigger differences within trade policy, and that will matter for markets. You know, Trump obviously has former President Trump has been discussing policies that could be quite disruptive just in terms of their scale and scope if they're implemented the way that he's discussing. You know, so I think that you have to be mindful of that type of risk. And as a result, you have to keep a pretty defensive portfolio.
Is this potentially the biggest risk to the soft landing, the U.S. election?
Yeah, I mean, certainly, you know, when you look at the tariffs and the you know, the aggressive nature with which he's talking about doing them, 60% on China, 10% everywhere else, you know, there's a quote transition cost to that. The economy will have to transition to some new place after you implement those, and it would likely cause elevated recession, elevated inflation, the potential for recession. It would be a really tricky spot for the Federal Reserve as a result. And it just creates business uncertainty. So you don't have businesses that want to invest. You don't have consumers that want to buy durable goods, for example. You know, and that's happening potentially on a global scale. You know, so I think there's definitely some huge risks here around the election. Now, there's a question around if he and will he implement the things that he's talking about. You know, of course, you know, President Trump obviously likes to look at the equity market as a barometer of his overall success. We can't imagine that the equity market would do well in that kind of scenario, so probably will temper him. But nevertheless, it's a risk that markets and portfolio managers have to deal with.
Maybe making quick U-turns on policy, depending on how the S&P 500 or, for the former president, the Dow Jones does on a specific day. You mentioned the deficit, fiscal policy, both these individuals, vastly different corporate tax rates. What does that mean for the overall health trajectory of the U.S. deficit?
Yeah, well, really, the longer-term issues around the deficit, you know, are less about these, you know, more discretionary pieces that are being discussed. You know, they're really about the non-discretionary programs and the trajectory of demographics in the United States. So, like Social Security, Medicare, and Medicaid. You know, neither candidate has said that they're going to touch either of these programs, and you really can't change that longer-term trajectory without doing so. You know, so as you know, we've sort of suggested, you know, this is really just, you know, tinkering around the margin. We think they probably will come up with a plan. We have to, you know, we're dealing with the Trump tax cuts, the Tax Cuts and Jobs Act extension. You know, most of those will probably be extended. Potentially, there could be some pay-fors. Of course, the Harris side is talking about through higher corporate tax rates, while the Trump side is talking about raising money through tariffs. So, you know, there certainly will be differences, but overall, we don't think it's going to make a huge dent in the longer-term trajectory of the U.S. debt.
Tiffany, we'd really appreciate your outlook as well on the upcoming information that we'll get off the back of the hurricane that's about to strike Florida. The incoming economic data might be very distorted, muddied by the hurricane that we've had before, Hurricane Helene, and the one we're about to get overnight, Hurricane Milton. The fact that in between some ports were shut as well. How are you and the team thinking about the incoming data over the next month or so off the back of those issues?
Yeah, well, certainly it's going to be noisy. You know, the first issue is just that there is a reduction in activity, usually in the month when the hurricane hits. You know, but then afterward, you know, there is more rebuilding. You know, we obviously, our hearts go out to the folks that will be impacted. But just from an economic perspective, you do tend to get a bit of a surge in activity after these kinds of events. You know, again, just because of that rebuilding. You also tend to just get more inflation. You know, used car inflation, as as you have an increased level of flooding that is resulting in replacement activity for cars tends to rise. So, it just tends to, create a kind of inflationary environment. And that's something that the Fed is going to have to watch. Now, we don't think that, the impacts will be like what we've seen over the past few years in terms of inflation. But it's certainly something that, could keep the Fed on edge, over the next several, quarter or so, as we're kind of working through the effects of this in the economy.
On edge and not on pause, not on hold?
Yeah, well, our own view is that the Federals are a range of scenarios here. They can continue a sequence of rate cuts, and we compare their policy rates to Taylor rules. Things, kind of normative rules of where policy can be. And they have a lot of room to cut interest rates here. So, they waited, they were delayed in cuts relative to what their own rules would have suggested. And now they have, more room. And we think as a result of that, they probably are embarking on a sequence of cuts, 25 basis point rate cuts. We think the recent data, by the way, has taken some downside risk out of that. But 25 basis point cuts at every meeting between now and, say, March before you slow down to try to figure out where the neutral rate is, seems reasonable to us. You see how the economy responds to that, and then you go from there.